So this, this is the big one economically that we get every month. You say the kind of the granddaddy of them all. It's like borrowing a Keith Jackson phrase if he was an economist. But what do you think we got today? What was the message behind the number? I know it was a little less than expected.
I think the message behind the number is that it reduces fears that the economy is overheating.
Right.
It should reduce concerns that there's so much demand for labor that it'll fuel inflation and cause the Fed to raise rates. So I think the main message is it counters some of the strength we've seen in the recent inflation data, and I think it does increase the likelihood that the next move out of the Fed is a cut as opposed to a hike.
It's always I mean, I know you know this, but it's a weird, for doing this a long time, message for regular people to say, it wasn't great, but it's exactly what we need, right?
That's right.
But it is sort of like that, right? You don't want it to be terrible, but you also tell us why you don't want it to be a quote-unquote great number right now.
Well, too much of a good thing can sometimes be a problem, right? And
that's true.
So for the last 6 months, we had been averaging closer to 275,000 jobs a month on average, right? The concern there is that generates so much income growth and so much spending that demand outpaces the ability of the economy to produce goods, and it pushes inflation higher. So yes, there are times when too much of a good thing would be a negative for the economy. So slowing things down a little bit gets you in a slower and steadier pace, and that's easier to manage.
You look around this economy right now, where do you see positives? And, where are we struggling? Are there areas of the job market, someone's going out of school or switching jobs that look stronger than others? Where's the strength?
Well, the strength is actually pretty broad-based in terms of the number of sectors that added jobs versus those that lost. Far more sectors added jobs than lost. So the real strength, though, is on the services side of the economy.
Yes.
Because still, even in 2024, we're recovering still from COVID and the pandemic. So there are some sectors where employment's been running still below pre-COVID trends. And those are largely your face-to-face, what we call high-touch services sectors, leisure and hospitality, education and health. So that's still where a lot of the residual demand for labor is.
Okay, the big story in the economy, period, whether we're talking about politics or just having a conversation about the economy, has been inflation for a long time right now. Curious to get your outlook. The Fed puts a target on inflation. They say we wanted at 2%. We're not there. I had Mark Zandi, who I'm sure you know of or know, who's an economist at Moody's, on the show yesterday. We had that conversation about getting back. I want to play that clip and then talk about where you think we are. Here's what Zandi had to say.
I do think inflation will continue to moderate. It's not a straight line, with economic data zigs and zags month to month, but I think all the trend lines here look pretty good. I mean, the only difference between where inflation is today and the Fed's target, the 2% target, is the growth in the cost of housing services.
So he thinks we're getting back there relatively soon, at least within the year or so. What do you think yourself?
We're similar. I think it'll take a little longer. I think we would caution that inflation's a little stickier. It may take longer to come down. But direction-wise, Mark and I are on the same page.
Why is it so sticky? Why is it stubborn, sticky, whatever word?
Well, I think it's because where we're adding a lot of jobs is in services. The engine of the U.S. economy is services, and we're playing catch-up on that side. And coming out of the pandemic, activity has rotated back to services. We're doing experience-oriented consumption still in 2024. And services prices, if you look back over time, they almost never fall. They either rise faster or rise more slowly. So in terms of getting overall inflation down to 2, you've got to lean on services inflation, which would never really want to fall anyway. And that's why I think it'll be sticky.
The final thing, and I promise this is not a political question. It could have political implications, but it's not a political question inherently, is that do you think all these surveys we take of people where they say, this economy is not great, I don't feel it, do you think that feeling that people have about the economy, given what you know about the outlook and the numbers, will change anytime soon?
I think over time it's getting better, right? So the University of Michigan consumer sentiment data, for example, and the Conference Board set of data are the two main ones that we all look at. The University of Michigan tends to focus more on inflation, and that confidence number is lower.
Right.
The Conference Board has a lot more questions about the labor market. So that actually is a more positive survey. So if the labor market stays relatively healthy but inflation comes down, then I think the answer is the consumer on average should feel a little better.
All right. We'll see. There's a look at the unemployment rate coming down. Mike, thanks for coming in.
Thank you very much.
Mike Gapen, Bank of America. Thanks so much for watching. Just go to joinnn.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.